Welcome to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business in Toronto, Canada. Today we're going to talk about accounts receivable. First, we're going to look at the general topic of receivables and bad debts, and then we're going to look at two particular methods that are used with respect to receivables: the aging of receivables method and the percentage of credit sales method. Let's look at receivables and bad debts then. What is accounts receivable? Accounts receivable is just the amounts that are owed to a company, and it could be, by anybody. But when we talk about accounts receivable in this course, we're talking mainly about customers who bought from a company on credit. Now, why would that company offer credit in the first place? The obvious thing is to increase revenue. You know what it's like when you see those buy now, pay later terms. You may end up buying stuff that you can't afford, and that may be a problem for you later on, but it's great for the company because they've got revenue that they wouldn't otherwise get. A second reason would be that if other vendors in that industry are offering credit, a company may have to offer credit itself just in order to compete. A third reason that's offered by the textbook is this one, which is about earning interest income. And frankly, I don't think that's really much of a factor these days. Oftentimes, if you are buying something on credit, you'll notice that you have to fill out a credit application, and it might be an entirely different company's name at the top of the credit application. So what's happened is the vendor has contracted with a credit company to provide credit to its customers. The credit risk is taken by the credit company, and the vendor of the goods or services is getting paid a discounted amount by the credit company in order to entice the sale from the customer. That way, the vendor doesn't have to worry about managing credit at all. However, if the company does offer credit to its customers, it's got an accounts receivable asset, and that is typically a current asset. I just want to set aside the possibility that a company might have long-term receivables. Of course, that's a possibility in certain industries. But in that case, a company needs to use complicated valuation models to deal with net present value and so forth. That's beyond the scope of this course. So we're simply talking in this course about accounts receivable as a current asset. Let's compare two basic scenarios. On the left, you've got the cash sales scenario, and on the right, you've got the credit sales scenario. So with cash sales, it's very straightforward. The customer will pay the company cash, and that is revenue. Debit and credit balance out. You've got cash increasing the current asset section of the balance sheet, and therefore increasing the asset side of the balance sheet. The revenue increases the net income, which increases the retained earnings figure in the equity section of the balance sheet. And that way, with the assets going up and the equity going up by the same amount, the balance sheet remains in balance. With credit sales, you've got just a delay between the sale and the collection of cash. So the first event at the time of sale is that you do recognize your revenue because you've sold something, but you haven't received cash yet. So what you have received instead is an intangible asset, the right to collect the $1,000, in this case, from the customer. And that is an asset. So it's classified as a current asset in this case because you're expecting to collect it within the next fiscal period. Most companies, their receivables are, in the neighborhood of 10 to 30 or 40 days. So it's well within the upcoming fiscal period. So it's definitely a current asset. At the time of collection, this is going to be a separate event at a later point in time. The customer is going to pay you the amount that's owed, and you're going to wipe out the accounts receivable amount that was set up. What you end up with, of course, is that you've got the debit to cash, just like you had in the first case on the left, and the credit to revenue. Those are the things that are left over at the end of the day. And so everything works out the same. So all that's happened is you've had this intervening time between the time the customer walked away with the goods or received the services and the time they pay. If you've got an accounts receivable asset, you've got two issues that you need to think about because it's not always as simple as we just saw. The first issue is, how do you handle bad debts? That's when a customer doesn't get around to paying and you're worried that they're not going to pay, and you may eventually find out that you can't collect from them. The second issue is what value should be shown on the balance sheet for the accounts receivable asset. Let's deal with the first issue. I'm going to talk about the direct write-off of bad debts. So this is the very basic method for handling bad debts from customers. The direct write-off method is so simple that it's really only useful to companies that have very negligible bad debt expenses. So if you've got a situation where you hardly ever sell on credit, or you sell on credit to customers who fortunately almost always pay you, then this method might be appropriate. Let's see how it works. Let's imagine a situation where you've got a customer who can't pay the $1,000 owed to the company. You've investigated the situation. You have decided that they're never going to get around to paying. They have the goods or services that you sold to them, and you're just not going to get paid for it. What do you do? Well, the direct write-off method involves, first of all, eliminating the accounts receivable that you had set up, right? So when you sold to the customer, you had a debit to accounts receivable, credit to revenue. So now you have to get rid of that accounts receivable. But where does the debit go? One possibility would be to put the debit back against revenue and simply reduce the revenue event. But remember, you've already got the cost of goods sold or the cost of services that you incurred to provide the goods or services to the customer. So that's going to misrepresent your gross margin. So what we do then is we record a debit to a bad debts expense. So it'll be a separate expense category. And by doing this, we maintain a full record of all the sales and all the bad debts. And this gives us the information that we need to manage our credit policies. We may decide in the future by examining this that we're going to reduce the risk by selling to only certain kinds of customers or only in certain circumstances. But this information will be valuable to us as a management tool. So that's why it's done rather than simply debiting the revenue. There are, however, problems with the direct write-off method. The first problem is a balance sheet problem. Prior to this write-off event that we just looked at, the accounts receivable value on the balance sheet is overstated because it includes $1,000 that we already know we're unlikely to collect. So when we first created the accounts receivable, that seems reasonable, we're going to collect, but as time goes by, our certainty about collection is going down and down and down, and therefore our accounts receivable is overstated. The second problem is a matching problem. So this is an income statement issue. You may have a situation where you've got sales towards the end of one fiscal period, and it's not until the next fiscal period that you encounter the bad debt that you realize that you have to write the bad debt off. And so you're going to have an expense recorded in that fiscal period. And that's really messing up two consecutive fiscal periods, right? Because the first fiscal period, you've got revenue overstated because you haven't matched the expenses to it. In the second fiscal period, you've got extra expenses in there, so your net income is too low. So we need to find ways to address both of these problems. The solution to both these problems is to set up an allowance for doubtful accounts. The allowance for doubtful accounts is an estimate of the future bad debts based on the sales that have taken place to this date. So it's set up at the year end as a contra account to accounts receivable. So what this means is that the amount that's shown on the balance sheet for the current asset of accounts receivable is the net of the face amount of the accounts receivable and the allowance for doubtful accounts. So that solves the problem of the accounts receivable being overstated. And then we're going to use up that allowance in the following year, and that solves the matching problem. We end up with the bad debts expense being recorded in the same period as the revenue event, and then when the bad debts event happens, there's no effect on the financial statements. Let's see how that works. The method is fairly straightforward. You recognize the estimated expense in the same period as the revenue. Now, how to do the estimate is something that we're going to cover in a moment. But you end up with a very straightforward journal entry. You have a debit to the bad debts expense for a certain amount, whatever the estimate was, and a credit to the allowance for doubtful accounts. So you end up then with the bad debts expense showing on the income statement for the same period as the revenue, and the allowance for doubtful accounts is set up as a contra account to accounts receivable, providing us with a better estimate of the net realizable value of the accounts receivable. Once this is done, then you're going to, in the future, in the subsequent fiscal year, run into situations where you have to write off the bad debts, and you write it off against the estimate. So what happens then is that you're going to eliminate the amount from accounts receivable, in this case it's $21, and you're going to debit the allowance for doubtful accounts. So you can see that both of these accounts are the two accounts that go into the disclosed value of the net realizable value of accounts receivable. So by taking a little bit out of each of those two accounts, the total or the net of those two numbers doesn't change at all. You're reducing both the accounts receivable and the allowance by the same amount. So the disclosed amount of accounts receivable doesn't change. And of course, because these are both balance sheet accounts, there's no effect on the income statement at this moment in time. There are two ways of estimating the potential bad debts that you need to know about. The first is the aging of receivables method, which produces better valuations on the balance sheet. And the second is the percentage of credit sales method, which produces better matching on the income statement. Let's look at those in more detail. So first, the aging of receivables method. The aging of receivables method is something that focuses on the balance sheet. So what you're trying to do is estimate the net realizable value of accounts receivable. And you do this by estimating the allowance for doubtful accounts, because of course the face amount of accounts receivable is a simple total of all the accounts. So all the estimation happens around the allowance for doubtful accounts. It's done by categorizing your accounts receivable by the age of the account. So the theory here is that the longer an account is outstanding, the more likely it is that the customers run into problems and will be unable to pay you. So with each categorization that you make, each category that you set up by age, you then have to come up with some sort of an estimate of the likelihood of any account in that category being uncollectible. And this, of course, is going to be based on the experience of the company. And as time goes by and it gains more and more experience with its particular customers, it's going to do a better and better job of estimating that percentage that's uncollectible. But it's this step that is the one that requires the management's expertise. Everything else is mechanical, but this is the place where management has the most influence on the receivables number. Once, of course, you've estimated the amounts and you've categorized everything and estimated the uncollectible portion of it, then you just add up those estimates, adjust the allowance for doubtful accounts to match the total, and then that gives you your amount for accounts receivable for the year. What happens in the income statement? Well, the amount that you adjusted the allowance by becomes your bad debts expense. Let's look at that calculation in more detail. Here's an aging schedule. So this is a simple example where a company has $100,000 in accounts receivable, and they look at the dates of all the invoices that they've sent out, and they find that most of the receivables are in the first month. In this case, $52,500 are still within 30 days of having sent the invoice, and the customers, let's say, have 30 days to pay. So it's very unlikely that customers are going to fail to pay. The experience of the company is that, in this case, only 2% of customers in that category have ever failed to pay. So multiplying those two things together, we end up with an estimated amount of uncollectible receivables for that category of $1,050. The next 30-day period contains $24,000 worth of invoices. And based on past experience, the company knows that there's a slightly higher likelihood that these accounts might not get paid. And multiplying the $24,000 by the 4%, we get $960. In the 60 to 90-day category, those invoices that are 2 or 3 months old, in this case, we've got $11,000 of total invoices. And our experience is that it's slightly worse. We're running into about a 5% likelihood that they won't get paid. And that gives us a $550 number when you multiply those out. And in the greater than 90-day category, so invoices that are more than 3 months outstanding, we know from past experience that there's a 10% chance that we're not going to collect. And that gives us a $1,250 estimate for that category. Totaling those up gives us a total estimated uncollectible amount of $3,810. So what this means is that out of the $100,000, we're estimating, based on our past experience, that the amount in that $100,000 that we might not collect is going to be around about $3,810. So all of these figures are quite mechanical, except for these ones. Those ones right there are the ones that are the estimates, and those will vary from time to time as we gain more experience. Certainly, they would vary from company to company and industry to industry. So that's where the management has the most influence right there. The experience, for instance, in the greater than 90-day category could be much, much higher for a company. Companies may find that there's only a 10% chance of collecting, let alone a 10% chance of it being uncollectible. So you have to look at exactly what your experience is and use that to come up with the best estimate possible. Once you've estimated your allowance for doubtful accounts, what do you do with it? Well, there's two possible situations that you might face. The first is that last year when you did this, you overestimated. So if that's the case, you're going to have some of the allowance from last year left over. So in this situation, you can see that we have an accounts receivable face value of $100,000, but we've got $400 sitting right there in the allowance for doubtful accounts from last year. We want that allowance to be $38.10, as we did the calculation on the previous slide. So what do we have to do? We have to do a journal entry like this. We're going to credit the allowance for doubtful accounts for only $34.10. That's going to bring the balance to the amount that we want, $38.10. What this means, of course, is that the balancing side of the entry, the bad debts expense, is going to be only $34.10. So this may or may not be a great estimate of the bad debts expense for the year, but our focus here is on making sure that the allowance for doubtful accounts is correct. Since it already had $400 in it and we want it to be $38.10, we're going to credit it with an additional $34.10, bringing it to the total. So this is what the disclosure is going to be. On the balance sheet, we're going to have accounts receivable disclosed as $96,190. So that's the face amount of $100,000 minus the allowance that we set up. So the first two figures there, the $100,000 and the $38.10, are not normally going to be disclosed to the average reader of the financial statements. All we're going to show them is that net realizable value. So that's the situation when we overestimated last year. The second situation is if we underestimated last year. So let's consider a situation where we underestimated, and as we debited the allowance for doubtful accounts through the year by writing off bad debts, we went past the total allowance and got into a situation where we continued to add debits to it, and we have a balance sitting there of $1,000 debit. Remember, the normal balance for the allowance for doubtful accounts is a credit. So if we've overused it, we're going to have too many debits in there, so a debit balance, in this case, of $1,000. What would that look like if we printed our accounts receivable right now? Well, it would look like we had $101,000 worth of accounts receivable because we got a face amount of $100,000 and our allowance is in a debit situation. So it's not going to be less the allowance for doubtful accounts. We're going to actually be adding to it, unfortunately. And that $101,000 figure is obviously ridiculous. We don't want that. So we need to correct the allowance for doubtful accounts so that it is $38.10 credit. If it's got $1,000 debit in there, then this is the journal entry. We need to credit the allowance for doubtful accounts for $48.10, which will bring the balance to $38.10. This means that the bad debts expense is going to be $48.10 for the year. And we're going to end up with the same situation as before. The accounts receivable is going to be disclosed at $96,190, consisting of the $100,000 face amount and the allowance for doubtful accounts that we wanted of $38.10. So as you can see, in both cases, we end up with the correct net realizable value of $96,190. But in one case, our bad debts expense is a little bit lower. The other case, it's a little bit higher than might be ideal. And that's fine as long as our focus is on the balance sheet. And that is what we're doing with the aging of receivables method. Let's look at the percentage of credit sales method. With the percentage of credit sales method, our focus is on the income statement. We're trying to match the expenses to the revenue. So what we're going to do is we're not going to be estimating the net realizable value of accounts receivable on the balance sheet. We're going to be estimating the bad debts expense itself. How do we do this? Well, we go over our credit sales for the year and we look at our past experience and we estimate the percentage of the credit sales that are uncollectible, not the percentage of accounts receivable, but the percentage of credit sales. And this estimate that we come up with here, that is our bad debts expense for the year. And we're going to add that amount to the remaining allowance. So the allowance for doubtful accounts and the bad debts expense are the two accounts that are involved. But in this case, our focus is to estimate not the amount that we have to add to the allowance for doubtful accounts, but the amount that we're going to record as a bad debts expense. And the other piece of that journal entry, the other side of that journal entry, is going to be the balancing part. So here's the calculation. It's much more straightforward, but of course, the amount of work that's involved for management to come up with the estimate is going to be just as much work because they have to review everything and make sure they've done a good job. But in this case, you've got, say, $1 million worth of credit sales. And based on our past experience, we know that every time we've got $1 million worth of sales, we have about a 0.5% chance of not collecting those credit sales, which gives us an uncollectible amount for the year of 5,000. Again, this is the estimate, right? We're just trying to estimate what is the bad debts expense based on that amount of credit sales. This is the calculation then, and this is what happens at the end of the year. Suppose that last year we estimated our bad debts expense, and we had an allowance for doubtful accounts, and we used it up, and at the end of the year, we've got $100,000 of accounts receivable. We've got $400 worth of allowance left over for a net realizable value of 99,600. But now we've done an estimate of the bad debts expense by looking at this year's credit sales, and we come up with a figure of $5,000. That was the calculation that we just did on the previous slide. So we're going to be debiting the bad debts expense because that's what we want to get accurate. We've already calculated that that's the right amount to match to this year's credit sales. The balancing side of that then has to be the credit to the allowance for doubtful accounts of 5,000. What's the impact going to be? Well, the AR disclosure on the balance sheet is going to be 94,600. Why? Because we had $400 in there already, and we added $5,000 to it, and we're going to get a figure of $5,400 as our allowance for doubtful accounts, giving us a net realizable value of 94,600. So again, on the balance sheet, the only amount that we're showing is the 94,600, the net realizable value. But we've got a situation where the allowance for doubtful accounts is not necessarily ideal. What is ideal, as far as we're concerned, is that bad debts expense because our focus is on the income statement. So we do have the potential, of course, that the estimates might be slightly biased. If we are doing a good job of estimating the bad debts expense, in some years we're going to have slightly high allowance for doubtful accounts. Other years we're going to have a slightly low allowance for doubtful accounts. But overall, it's going to be, roughly good enough. But if our estimate procedure is biased and we consistently underestimate or consistently overestimate, you may find that that allowance for doubtful accounts right here, which remember that is the balancing entry, right? Where our focus was on the bad debts expense. But if that balancing entry is slightly biased, you could find that the allowance for doubtful accounts will grow or shrink consistently over time until the point when the net realizable value is misleading. And at that point in time, when we realize that this amount right here is actually misleading, at that point in time, you may have to do an adjusting entry to bring it back into line. Now, this won't happen if your method for estimating the bad debts expense just experiences random differences. But if the differences are not random, if they're biased in one direction or another, you're going to end up with a situation where the accounts receivable amount that you show on the balance sheet is misleading, and you're going to have to do a one-time adjustment to bring it back into line. Let's summarize what we've learned about accounts receivable. We started out in this lecture by looking at the general concept of accounts receivable and bad debts, and we looked very briefly at the direct write-off method, which is the method that's used by companies that don't generally have a bad debts problem. So there's no reason to use any more sophisticated method other than directly writing off the accounts receivable and creating a bad debts expense at the time that the write-off is done. The other two methods, the aging of receivables method and the percentage of credit sales method, were used to achieve better net realizable value on the balance sheet, and in the second case, proper matching of bad debts expense. So both of those methods will achieve those goals to a certain extent. Both of them will improve the net realizable value that's disclosed on the balance sheet. Both of them will produce better matching. But in the one case, you have a focus on the balance sheet, and in the second case, you have a focus on the income statement. It's all about money, money, money. Ooh, money, money, money. Ooh, yeah. Dollar signs in your eyes. You only want to make yourself some